Hey friends, I am back in Manila. Came back from Boracay. I kind of miss Boracay already, but it's good to see friends and be in the city again. So I thought today I would talk about another Greek. Last time we talked about delta, and so delta describes how the model predicts your P&L will change based on a small move in the underlying. And Vega is similar. So Vega predicts how your P&L will change based on a move in implied volatility. So if you're new to options trading, you might be wondering what the heck is implied volatility, and that is largely what we're going to talk about today. If you think about selling a put, something like SPY, maybe $10 below the market, and you're coming up with the price is based on the risk of that position. And your risk in selling that put is tied to how likely is it that the SPY is going to crash down like 2.5% in the next 20 days in this case. So that the likely size of a move up or down in the underlying, that is expressed as volatility. And that is one of a variety of inputs that go into options pricing models. So the most popular model is something called Black-Scholes, but regardless, you have a bunch of numbers that go into the formula, and then it will spit out, this is the model's estimate of a fair market price for that option. So these things include how many days to expiration the option has, what's the current price of the underlying versus the strike price of the option. Interest rates are a minor input, but then also this concept of the volatility. In other words, how big of a move is likely to happen. Now, if you ask 10 different traders what's the underlying price or what's the strike price or days expiration, you're going to get the same answer. The problem with volatility is it's completely subjective. So if you ask 10 different traders how big of a move they think S&P could make, you're going to get 10 different answers. So in options trading, actually, what's usually done is it's flipped on its head. We have one more value that we do know with certainty, and that's the actual price of the option. So what options traders do, and what options platforms do, like Thinkorswim, is they plug in the actual price of the option into the output, and from that, they reverse engineer what volatility would you have to put in with all of the other parameters that we know to get the price to come out at this value. And so another way of saying that is, what is the volatility that is implied by the price that we see in the market? And that's why it's actually called implied volatility in your options trading platform. So since every option has its own strike and its own pricing, implied volatility is calculated for each option individually, but options platforms will collapse this into a single representative value for the underlying as a whole. So here in Thinkorswim, it's coming up with 13.5 as its sort of SPY implied volatility value. I also have a watch list over here. I've added an implied volatility column, and you can see for SPY, this is what it's come up with. And you can see that it thinks, for example, NASDAQ is more volatile than the S&P. That's actually not that surprising, right? Now, because we have this composite single value of implied volatility for something like the S&P, just like we plot the price of the S&P over time, we can also plot that IV composite value over time. So you can see where implied volatility has been versus where it is now, and it can give you an idea of the kind of jumps and fades you can get in implied volatility, which you can combine with your Vega number to get an idea of how your P&L can bounce around over time. So this can give you an idea if implied volatility is relatively low lately or if it's relatively high, what kind of a move up in implied volatility you might experience. Combine that with your Vega to get an idea of what that might do to your P&L, perhaps even short term. Or if your P&L is suddenly down, but you see implied volatility has spiked up, maybe you expect it to come back down again, something to keep in mind. I would always obey any stop loss rules or anything like that you have, but it's just something to be aware of. Now, some traders like to wait for a high IV before they enter a trade in, like, say, an iron condor in the SPY. And that's fine. There's nothing wrong with that. but it depends on where your cutoff is. So for example, if your cutoff was 20%, which is zero point 0.2 on this chart, you've been sitting out of the market for the last 2 months, and you could be sitting out for a year or more. So that's the danger. But there's certainly nothing wrong with being selective. If you trade a variety of underlyings, you might choose one where its implied volatility chart actually, seems to be a bit higher compared to historic values. That can be something that you do. Or you can simply choose to enter, repeatedly something like the put credit spread strategy where you're just putting one on every week. That can be fine too. It's really a trade-off between being opportunistic but having yourself sitting in cash a lot versus always taking advantage of the edge that's always there in the market, but sometimes you're going to get in when IV is low and you might get hurt a bit. Also, I don't use Tasty Trade very much, but just to show that platform, here I'm looking at SPY, and if you look in the quote details, you can find the IV here. They've got 13.4 right now. And then here is a watch list with SPY, and I've got the IV in here, and it's 13.4. So they have it as well. The other thing I want to mention is the VIX. So you see this implied volatility chart of SPY. The S&P is such a sort of representative market. It's so heavily followed that the CBOE has created their own index. They publish numerical index called the VIX, and all it is the CBOE's composite IV value for the S&P. And so this is essentially the same as that IV chart you saw below SPY. But when you see people talking about the VIX on CNBC or whatever, this is what they're talking about. It's also sometimes called the fear index because, how afraid are you of that $10 move down, right? So this is the VIX. Now there was this really great article on Seeking Alpha that's kind of related, where they looked at the volatility risk premium. Volatility risk premium is essentially the edge in selling options. It's not just the premium that you collect. They looked at what the implied volatility was, like how big of a move was priced into the options, and then they compared it to how big of a move actually happened. So it really is a pretty good gauge of the extra edge that we try to profit from. Now, they broke these markets up into 5 different volatility regimes, 5 quintiles, and in the highest volatility entries, you can see that they actually, have a slightly higher return. But the question would be, is that what you really want versus sitting out of the market 80% of the time? And that's kind of the core question. So there's no right answer. And like I said, you could also be selective about what underlyings you trade to try to target things that have currently a high relative IV to where they've been in the past. But that's kind of the basics of how IV works. So for me, I tend to be always in. There are times where what I've done is I've split the difference. So maybe I trade iron condors when IV is low, but I trade them smaller. And then when we get a spike in IV, I put the other half of the position on. That can be another thing you can do. But mostly I just wanted to mention implied volatility, talk about where it comes from, what does it mean, what does Vega mean, and make you just aware of the VIX. So just a real short video. Next time I'm probably going to cover broken wing butterfly strategy. So this is another delta neutral strategy, the way I'm going to show it. And can be a good alternative to iron condors, depending on what you're looking for. And it's a good next step towards where I eventually want to go with these videos. So yeah, looking forward to that. If you want to see it, please hit subscribe. If this is useful, hit the like button. I just hit 100 subscribers. I am so grateful to all of you who have subbed the channel already. Thank you. I appreciate you being here, and I will see you next time. I just wanted to share, it is really coming down today. Oh my God. Wow. Crazy. Absolutely crazy. Ugh. Anyways. Alright, that's all. See you guys next time.